Why first-time buyers fail. Why do most first-time property buyers end up losing money even when everything seems so promising at the start? That is the question we are diving deep into today, and I promise you, the answers are going to completely change how you think about buying investment property. If you are new here, welcome to the channel. Please take a second right now to hit that like button, subscribe, and ring the bell so you never miss a video. And if you are already part of this community, thank you so much for coming back. Today we are looking at 4 real case studies that reveal exactly where first-time buyers go wrong, and more importantly, what you can do to protect yourself from making the same costly mistakes. Hello again, I am Nelius, and let us start with the very first case study, and this one is probably the most common story I hear from people who reach out to me. A first-time buyer, excited and full of energy, finds what appears to be the perfect starter investment property. It is a 2-bedroom apartment in a decent suburb, listed at what seems like a reasonable price. The numbers look good on the surface. The asking rent in the area is around $1,500 per month. The mortgage repayment comes in at around $1,200, and the buyer thinks they are going to pocket $300 every single month. Simple math, right? Wrong. What this buyer failed to account for was everything that sits between the rental income and the actual money that lands in their pocket. There were body corporate fees of $320 per month. There was council rates, water charges, landlord insurance, and property management fees stacking up. Within the first 6 months, the property sat vacant for 7 weeks because the buyer had no system in place for finding and screening tenants. That 7-week vacancy alone wiped out months of projected profit. Then a plumbing issue emerged that cost over $2,000 to fix. By the end of the first year, instead of making money, this buyer was behind by nearly $4,000. The brutal lesson here is that positive cash flow on paper almost never survives contact with reality, unless you account for every single expense, vacancy periods, and unexpected maintenance costs before you buy. First-time buyers consistently underestimate the true cost of ownership, and that gap between what they expect and what actually happens is where the money disappears. Now, here is something critical I want you to understand before we move to the second case study. Financial literacy around property investment is not something most people are born with. It is learned, and the faster you learn it, the less money you lose. That is exactly why I put together my effective property management course, where you get comprehensive step-by-step guidance on how to manage investment properties the right way from day one. You can become a member right now by clicking the link in the description below. Thousands of investors have used this course to transform how they approach property, and the difference it makes is enormous. But let us keep moving, because case study number 2 is even more eye-opening. The second story involves a buyer who purchased a standalone house in a regional town. The property was affordable, which was the main attraction. The buyer had done some research, noticed that rental demand in the area seemed strong based on a quick online search, and decided to move forward. The purchase price was attractive, the rental yield percentage looked healthy, and on paper this seemed like a smart contrarian move, getting into a market that city investors were overlooking. What the buyer did not investigate deeply enough was the local economy driving that rental demand. The main employer in the town was a single large manufacturing facility, and within 18 months of the purchase, that facility announced significant workforce reductions. Almost immediately, rental demand softened. Long-term tenants started moving to find work elsewhere. Vacancy rates in the town climbed sharply. The buyer found themselves cycling through short-term tenants, dealing with periods of no income, and watching the property value stagnate while similar properties in growth corridors were appreciating. To make matters worse, because the town was small, finding quality tradespeople for maintenance and repairs became a logistical nightmare. Costs were higher, response times were slower, and the stress of managing a property remotely in a struggling market was relentless. After 3 years, the buyer sold at roughly the same price they paid, but after accounting for all costs, transaction fees, And the opportunity cost of that capital sitting tied up, the real financial loss was significant. The lesson from this case study is that location analysis goes far deeper than just looking at current rental yield. You have to understand what is driving demand, whether that demand is sustainable, what the economic diversity of the area looks like, and what the long-term growth indicators are telling you. Buying cheap in the wrong location is not a bargain. It is a slow financial drain. Here is another layer to the story that most people do not talk about. When you are managing a poorly located investment property, the emotional and time cost is enormous. Stress, sleepless nights, constant problem solving, all of that has a real cost, even if it does not show up directly on a spreadsheet. This is why proper education before you buy is not just about money. It is about protecting your quality of life. That is also something my free ebook, How to Manage Properties Like a Pro, covers in real depth. You can download it right now using the link in the description below. There is also a free course available at the same link that goes hand in hand with the ebook and gives you a practical foundation for smart property management. Do not skip these resources. They exist specifically to help you avoid the kinds of mistakes we are talking about in this video. Let us now move into case study number 3, and this one carries a slightly different type of lesson, because the mistake here was not about the property itself, but about the people involved. This buyer purchased a solid property in a good location. The fundamentals were genuinely strong, the suburb had good growth history, the property was well maintained, and the buyer had even done a decent job of running the numbers. On paper, this should have been a success story. The problem was tenant selection. Desperate to get the property tenanted quickly after settlement, the buyer rushed the screening process. The first applicants who came through seemed pleasant enough in person, provided references that were not properly verified, and moved in within the first 2 weeks. The legal process of addressing the tenancy issues, navigating the relevant tribunal system, and ultimately regaining possession of the property took months. The cost of repairs after the tenants left ran into thousands of dollars. Rental income during the dispute period was inconsistent and stressful to pursue. What went wrong here is painfully clear in retrospect. The foundation of a profitable rental property is not the bricks and mortar. It is the quality of the people living inside it. Proper tenant screening, verifying employment history, checking rental references by actually calling previous landlords and asking the right questions, conducting thorough background checks. All of this is non-negotiable. Skipping these steps to fill a vacancy quickly is one of the most expensive shortcuts a property investor can take. A vacant property costs you rent for a few weeks. A bad tenant can cost you thousands of dollars and months of legal battles. Let me pause here because I think this is a good moment to reinforce something important. Every one of these mistakes we have covered so far, the miscalculated cash flow, the poor location choice, the rushed tenant selection, they are all preventable. They are not bad luck, they are knowledge gaps, and that is something you can fix right now. My effective property management course is designed specifically to close those knowledge gaps so that you walk into every investment decision with confidence and clarity. Click the link in the description to become a member today and give yourself the tools that most first-time buyers simply do not have when they need them most. Your future self will genuinely thank you for it. Now let us get into the fourth and final case study. And in many ways, this is the most sobering of all because it involves someone who actually did quite a lot of things right at the start, but still ended up in a very difficult financial position. This buyer purchased a property in a growing urban corridor. They did their research on the suburb, they ran the numbers carefully, they screened their tenants properly, and for the first 2 years, things went reasonably well. The property was tenanted consistently. Cash flow was slightly negative but manageable, and the capital growth in the area was performing as hoped. The problem emerged when interest rates began rising. This buyer had purchased at a time of historically low interest rates and had structured their entire investment strategy around those low repayment figures. As rates moved upward, the monthly mortgage repayment climbed substantially. What had been a slightly negative but manageable cash flow position turned into a deeply stressful financial burden. The buyer had not stress tested their budget against higher interest rate scenarios. They had no meaningful financial buffer or emergency reserve built up. When the property also needed a new hot water system and some roof repairs at the same time, the rate increases were biting. The buyer found themselves in serious financial difficulty. Unable to sustain the holding costs, they were eventually forced to sell the property at a point in time that was not ideal from a market perspective, crystallizing a loss when, had they been able to hold for another 18 months, the property would have recovered strongly. This case study is a masterclass in the importance of financial buffers, stress testing your numbers across different interest rate scenarios, and understanding that property investment is a long game that requires the financial stamina to hold through difficult periods. Timing a forced sale is almost always a losing proposition. You lose control, and in property, control is everything. Looking across all four of these case studies, a few themes emerge very powerfully. The first is that most first time buyers dramatically underestimate the true cost of property ownership. It is not just the mortgage, it is rates, insurance, maintenance, property management, vacancy costs, repairs, and a dozen other line items that quietly erode your returns. The second theme is that location analysis requires genuine depth. A suburb or town that looks good on a surface level rental yield calculation might have serious structural economic weaknesses that only reveal themselves once you dig deeper. The third theme is that people, meaning your tenants, are the most consequential variable in your investment outcome. Getting tenant selection wrong can be more damaging than almost any other single mistake. And the fourth theme is financial resilience. Having a buffer, having the capacity to absorb unexpected costs and interest rate movements, is not a luxury for experienced investors. It is a fundamental requirement for anyone who wants to survive and thrive in property investment. What is fascinating about all four of these stories is that none of the buyers involved were reckless or irresponsible people. They were ordinary individuals who were genuinely trying to build wealth and create a better financial future for themselves and their families. But they walked into a complex, high stakes environment without the knowledge they needed to navigate it successfully. That gap between enthusiasm and education is where the money goes. Property investment rewards the prepared and punishes the uninformed. Not because the market is cruel, but because the market is indifferent. It does not care whether you understood what you are getting into. It simply reflects the quality of the decisions you made. There is also a psychological dimension to all of this that deserves acknowledgement. When first time buyers see properties advertised with attractive yields or hear stories of people making significant returns, there is a natural urgency that kicks in. Fear of missing out is a powerful motivator, and it often pushes people to move faster than they should, to cut corners on due diligence, to skip the education phase because they want to be in the market yesterday. That urgency is understandable, but it is also dangerous. The best investors I have ever encountered are not the most impulsive ones. They are the most prepared ones. They take the time to learn the fundamentals, build their systems, and enter the market with a clear eyed understanding of both the opportunities and the risks. One more thing worth addressing is the role of professional support in all of this. Several of the situations we covered today could have been significantly mitigated or even completely avoided with proper professional guidance. A good buyer's agent, a thorough property manager, a quality accountant who specializes in property investment, and a mortgage broker who stress tests your borrowing capacity against multiple interest rate scenarios are not expenses. They are investments in your financial protection. Too many first time buyers try to do everything themselves to save money and end up paying far more than any professional service would have cost them. Knowing when to leverage expertise is itself a form of financial intelligence. We are approaching the end of today's video, and I really want to make sure you walk away with something genuinely actionable. So let me summarize the 4 core lessons from these case studies as clearly and practically as possible. First, before you buy any investment property, build a comprehensive cost model that includes not just your mortgage, but every single holding cost, a realistic vacancy allowance, a maintenance reserve, and a buffer for unexpected expenses. Run that model against multiple scenarios and make sure the numbers still work even when things do not go to plan. Second, when you are evaluating a location, go beyond yield percentages. Research the local economy, the employment-based population trends, infrastructure investment, and long-term demand drivers. Strong fundamentals today mean nothing if the underlying economic drivers are fragile or singular. Third, never rush your tenant selection process. A vacancy is a temporary cost. A bad tenant is a potentially catastrophic one. Build a rigorous screening system. Verify everything and trust the process even when you feel pressure to fill the property quickly. Fourth, stress test your financial position against higher interest rates, extended vacancy periods, and major unexpected repair costs. If your investment only works under perfect conditions, it is not a safe investment. Build resilience into your strategy from day one, not as an afterthought. I want to remind you again about those 2 free resources waiting for you in the description right now. My free ebook, How to Manage Properties Like a Pro, gives you a practical, no fluff framework for managing investment properties effectively, regardless of your experience level. And the free course that comes with it takes you even deeper into the systems and strategies that protect your investment and maximize your returns. These are completely free, and they are packed with the kind of information that most people only discover after making expensive mistakes. Download them today using the link in the description below and start building your knowledge foundation right now. If you have found value in this video today, please do me a quick favor and hit that like button right now. Subscribe to the channel if you have not already done so. And share this video with anyone you know who is thinking about buying their first investment property. You could genuinely save someone from a very costly experience simply by sharing what you just learned here today. Property investment done right is one of the most powerful wealth building tools available to ordinary people. It has the potential to generate passive income, build long-term equity, and create real financial freedom. But done wrong, it can set you back years. The difference between those 2 outcomes almost always comes down to education and preparation. So invest in your knowledge before you invest in bricks and mortar. Learn the fundamentals, build your systems, surround yourself with the right people and the right resources, and approach every decision with clarity and confidence rather than urgency and hope. Thank you so much for spending your time with me today. Every single view, every comment, every like genuinely means the world to me, and I am committed to continuing to bring you the most practical, honest, and valuable property education I can. Remember, the link for my effective property management course, the free ebook, How to Manage Properties Like a Pro, and the free course are all sitting right there in the description below. Click through, explore them, and start giving yourself the unfair advantage that every smart property investor deserves. I will see you in the next video.